All right, let's get right into it. The Federal Reserve just cut interest rates. Now, for a lot of investors, that's the sound of the starting gun. But what if this big move isn't the green light we think it is? What if it's actually a carefully set trap?
I mean, this is the question, right? After all this time with high rates, we finally get a cut. The obvious move seems to be, okay, time to jump back in the market, big time. But what if that's exactly what they want you to think? You know, when one financial commentator, Tuat Tevand, was asked if this was the big moment to buy, his reaction wasn't a yes or a no. It was a laugh. That kind of tells you everything, doesn't it? It suggests there's a whole other story playing out behind the scenes.
And that's what we're digging into. According to one pretty detailed analysis, the official story we're hearing is just that, a story. It's a performance for the public. So we're going to break down that theory piece by piece to see why this rate cut might be the exact opposite of what it looks like.
Okay, so first, before we dive into the deep end, let's just quickly cover the official story. You know, the good news version that's got the markets all excited. So on the surface, you've got this perfect trifecta of good news, right? 1, the Fed makes money cheaper to borrow. 2, the tariffs, which have been a huge problem, might go away. And 3, the ultimate seal of approval. Warren Buffett himself is apparently buying stocks. I mean, on paper, that looks like a slam dunk. But here's where the theory starts to poke holes in that story. This is the first layer of doubt, and it's based on something it calls the impossible choice. So this all centers on a classic economic framework called the impossible triangle. And the idea is actually pretty simple. A country can have stable inflation and low tariffs. It can have low tariffs and low interest rates. It can have stable inflation and low interest rates, but it can never have all three at the same time. You can pick any two, but you always have to sacrifice the third. And this chart just lays out those painful trade-offs perfectly. If you want to protect investors and everyday people with low rates and stable prices, the government has to give up tariffs. If you want to protect the people and the government, you got to ditch the low interest rates, which hurts investors. And what if you want to protect investors and the government? Well, then you sacrifice inflation control, and that hurts the poor the most. The analysis argues that this third option is almost always the path they take. So let's peel back another layer. The author uses this really powerful metaphor to question the official numbers we're all seeing. They ask, what if the US economy isn't healthy at all? What if it's more like a cancer patient? Now, this distinction is absolutely crucial to the whole argument. You've got two kinds of rate cuts. A preventive cut is like taking vitamins when you're already healthy, just a little tune-up. But a rescue cut, that's like a shot of adrenaline for a patient whose heart is stopping. It's a big, fast emergency move. Now, the Fed is telling us this is a small preventive cut, but is the patient actually healthy?
I mean, on the surface, you'd say yes. Just look at this number. Headline GDP growth is a really strong 3.3%. That looks pretty healthy, right? But this analysis says, hold on, let's look under the hood. And when you do, you see that consumption, the main engine of the whole economy, is sharply down. And so are imports. So the claim is that Americans are earning less and spending less. That headline GDP number only looks good because of a weird quirk in how it's calculated. It subtracts imports. So when people spend way less on imports, it actually makes the final GDP number look artificially strong. It's masking a major weakness.
Okay, fine. But what about jobs? The job market is solid, right? The official unemployment rate is a fantastic 4.3%. That's got to be a good sign. Well, again, the analysis says you have to look at how that number is actually cooked up. Did you know that if you work just over 1 hour a week, you're not counted as unemployed? Or that if you've been looking for work for more than 6 months, you literally get removed from the statistics altogether? The argument here is that the real picture of unemployment is a whole lot worse than the official number suggests. Okay, so this brings us to the absolute core of the entire theory. It's this powerful metaphor for what's happening in global finance that the author calls draining the global lake. I love this visual because it makes it so clear. The argument is that the Fed is working with two hands. With one hand, it's pumping water in by cutting interest rates. That's the move that gets all the headlines. But with the other hand, it's quietly sucking water out by shrinking its balance sheet to the tune of $40 billion a month. And nobody's talking about that part. And here's the punchline. The analysis claims that the quiet sucking is way, way more powerful than the loud pumping. So the net effect isn't more money in the system, it's actually a massive drain of money from the entire global economy. And get this, it's not just the Fed. The author points out that the other giant central banks, the European Central Bank and the Bank of Japan, are doing the exact same thing. They're all shrinking their balance sheets at the same time. This isn't just a US thing, it's presented as a coordinated global move.
So why on earth would they do this? Well, the theory lays out this pretty dark, cynical three-step plan. Step 1. The big central banks work together to create a global shortage of dollars, euros, and yen. Step 2. This sparks a crisis. Emerging market currencies completely collapse because they don't have enough dollars to function. And step 3. Wall Street, holding all the cash, swoops in and buys up their most valuable assets for pennies on the dollar.
All right, so let's get to the end game. How do the big players on the chessboard fit into all this? And what's the actual strategy if you believe this theory?
Remember how we started with the news that Warren Buffett is buying? Well, let's put that into perspective. According to this source, he recently bought $5 billion worth of stock, but he also sold $8 billion. So he's actually a net seller. He's selling more than he's buying. Which leads to this pretty critical question. Is his highly publicized buying really a vote of confidence? Or is it a classic magician's trick? Look at my left hand, pay no attention to my right hand, which is quietly cashing out. So based on this entire analysis, what's the move? Well, the source suggests a very specific defensive playbook. First, avoid things tied to the dollar. Instead, focus on physical gold and silver where there are apparently shortages developing. It also points to the Japanese yen as a new safe place, a reservoir for capital. And for US stocks, the advice is to use guerrilla tactics. Get in, grab a quick profit, and get out before the whole thing comes down.
And that really brings us to the final, critical question this whole analysis leaves you with. If the official story we're all hearing is just a stage play, designed to get us to act a certain way, are you going to just sit in the audience and watch how it ends? Or are you on the chessboard, trying to understand the real game and make your own moves?